The average person thinks finance is so complex because, frankly, the industry tries to make it sound complex. They use words that you don't know, so you don't know what to do. If you can invest in business, even a small amount, you can grow.
Welcome back to another value-packed video. In this video, you will learn Tony Robbins' 6 secret rules of investing. Who is he and why should we listen to his advice? Tony Robbins is an author, entrepreneur, and life and business coach who runs a multi-billion-dollar business and has worked with top professionals across various fields. He has interviewed his financial giant friends like Warren Buffett, Ray Dalio, and John Bogle on winning investment tips, and today, you are going to learn all 6 of them. Before we jump into the first one, don't forget to drop a like if you get any value, and make sure you subscribe so you never miss a life-changing video. Number 1 rule of investing: you cannot earn your way into financial freedom. Most people are financial traders. I can hear you thinking, what the heck is a financial trader? It means trading your time for money. And you know what? This is the worst trade you can ever make in your life. No matter how many millions of dollars that athletes, movie stars, and entertainers have earned over the course of their careers, they always have to earn extra money to survive after they retire. Do you know that the easiest way to become wealthy is when you decide to keep a percentage of your income forever? This is money that you have to keep and invest and grow so that it will compound and provide you with an income for the rest of your life. Just 2 decades ago, the entrepreneur's mantra was to retire young and retire rich and do nothing for the rest of your life. But today, you see fabulously rich people, billionaires like Warren Buffett and Steve Wynn, who own almost all the gambling in Vegas, still working harder than ever before. These are guys in their 70s and 80s still going at it, despite having more than enough money to retire on. Your goal in life should be to discover how to make enough money so you'll never have to work for money. This way, you'll have enough time to do the work you love, and because you love the work you're doing, you will devote enough passion and put sufficient time into it. Number 2 rule of investing: compounded growth is the investor's best friend. Compounding is great. Albert Einstein called it one of the single greatest inventions of humanity. And once you understand it, it transforms everything else in your life. Know this: the biggest mistake you can ever make is to ignore the power of compounding. You actually need to tap into it and make it work for you. A great illustration of how compounding works is the story of Earl and Wyatt. Earl and Wyatt are friends who decided to save their cash and invest it in an index fund so their money can grow tax-free until they reach the age of 65 with an annual rate of return of 10%. Earl began investing his money at the age of 20, and each year he was investing $4,000 and getting a 10% rate of return on his money. After 20 years, he stopped and didn't invest another dime in the index fund. He was done. Wyatt, on the other hand, started investing his cash 20 years after Earl. He was investing $4,000 each year and getting a 10% rate of return on his money in a tax-protected environment. But unlike Earl, he did this for 25 years, and when he turned 65, he stopped and didn't invest another dime in the index fund. Now we take a look at the figures. Earl, who'd invested $4,000 for 20 years, had managed to put away $80,000, while Wyatt, who invested $4,000 for 25 years, had invested $100,000. Who among the 2 friends had actually used the power of compounding to build himself a fortune? I guess you're thinking Earl. You're right. Earl, who began investing much earlier than Wyatt, was much better off financially at the age of 65. But how better off, you might ask? Wyatt had a total of $400,000 at the age of 65, while Earl, who put in less money, had $2.1 million at the age of 65. That is a $1.7 million difference. 600% more money. You literally have to see the power of compounding on people's investments to understand its ability to change your financial future, and how it can free your mind from the delusion of needing that big score to be financially secure. Number 3 rule of investing: market crashes are hidden opportunities. You have to get this fact in your head right now. Market corrections are unavoidable, and they occur every year. What about the bear market, you might ask? In the last 100 years, the bear market has on average happened every 3 to 5 years. To be precise, there has been a bear market every 5 years during the past 30 years. And right now, we haven't experienced a bear market in 8 years. That means we are way overdue for a big one. Now listen, I need to get your mind in the right place. A bear market, or a market correction, is one of the greatest opportunities in your lifetime to make that financial leap from wherever you are currently to where you want to go. Hear this. This is your shortcut if you think you are way far behind or you believe that all the great opportunities have been taken. Your big gift is coming. Now I want you to take these cyclical waves of market panic and turn them into regular opportunities to improve your financial future. And the great news is that each bear market is linked to a bull. Take, for example, in 2008, the markets were plummeting, portfolios were being wiped out everywhere. But guess what happened in 2009? The markets were up 67%. Right after every single bear market in the history of the United States of America is an explosion of wealth on the stock market. Remember Warren Buffett's famous line about being greedy when people are afraid? That's the spirit you should be having during a market correction. In 2008, during the recession, he took out his wallet and went shopping. Remember, bear markets aren't the time to freak out and lose your shit. There's this metaphor that highly successful investors use: turn the snake into a rope. It's the story of the middle of the night and you are walking through a yard or someplace and you see a snake and you freak out and pull back. And you return in the morning and it's actually a rope. Once you know it's a rope, then you're never afraid again. Rule number 4 of investing: diversify your investments. One thing you need to understand about investing is that there is no such thing as a balanced portfolio. Those guys who thought they'd created a balanced portfolio of assets were the ones who got hammered on both sides during the market crash of 2008. The trick to figuring out how to properly diversify your assets is by balancing them according to their volatility. For example, if you are having a 50-50 portfolio of your stocks and bonds, that means you roughly hold equal amounts of stocks and bonds. That's a problem because equities are 3 times more volatile than bonds. This means your risk is not 50-50, it's more like 95-5. During a market correction, stocks get wiped out faster than bonds, meaning your portfolio gets hammered pretty quickly. Number 5 rule of investing: fees matter a lot. Watch out for your investment fees. They can take out more than half the income you should be getting from your investments. The fees you pay will go a long way in determining how much wealth you would be able to acquire from your assets. For example, if you invest $100,000 at 7% interest for 30 years and you pay 1% in fees, you would have $574,000 at the end of 30 years. However, if you were paying 3% in fees on the same investment, you would have $324,000 at the end of 30 years. That is 77% less money. The same returns, more fees. See the problem? This is practically highway robbery. Do not be a victim. Ask your investment broker what your fees are, and please, take your time to read through the fine print. If you can't, get a financial consultant to read through it and explain it to you. A lot of extra fees are hidden in there. Most investors don't have a clue what their fees are and they get ripped off. There are sites online where you can go and find out exactly what fees are and how much you should be paying. Lesson 6. Improve your business psychology. Investing is all about psychology. You might have the knowledge, you may have the skills and experience, but without the psychology, you won't be able to execute your investment plan properly and you'll lose all your money. A great example is the story of a guy named Mel Fisher who spent 27 years looking for a sunken Spanish galleon that was supposed to be filled with gold, and he found it after 27 years of searching. This is incredible because he went out each day for 27 years and found nothing. What was his strategy? What were his beliefs? How did he raise money to continue searching for 27 years? You need to understand that the major challenge that you face in your business is your psychology. Because if your business isn't working as it should, and you think you've maxed out on ideas and have tried everything possible, then you're being controlled by your beliefs, and you've missed the innovations and the answers. Mel Fisher found that gold because he has 3 beliefs. He believed there was a treasure out there, and he was certain it was out there. You must also believe that there is a treasure in your business. He believed that he would find the treasure, and it is also important that you must believe that you will find treasure in your business. He believed the treasure would be worth it. That's the reason Mel Fisher spent 27 years searching for it. And you also have to believe that it's worth it. Without those 3 beliefs, Mel Fisher would never have found that gold. When you change your psychology as an investor, your results immediately change. Experience and skills also count, but since psychology is directly linked to execution, your skills and experience don't matter when you don't execute. Knowing this, execution is more important than knowledge. Knowledge is trumped by execution every single day, and that execution comes from changing the psychology. If you enjoyed this video, please click the subscribe button for more amazing content.